And we're through the Powell testimony. And what are we left with? Not a whole lot, as it turns out. But of course, now the focus turns to weightier things, perhaps, as U.S. jobs data looks to put a number around what the Fed chair has been giving us more in qualitative rather than qualitative terms over the past 2 days. Welcome. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And today we are going to focus wholly on February's U.S. jobs data, what it means, how it might impact markets, why that impact might be there, and what this means going forward for stocks, for currencies, for rates, and where we are really across the financial markets at this point. So, needless to say, the most important question here as we get back to record highs on the S&P 500, as we return to the recent peaks in the NASDAQ is, do we need to be worried about this? Is this data that should concern anybody? And in looking at that, I think there's a couple things we need to keep in mind. So first, let's consider. We've made the trip since the beginning of the year up to now from 150 basis points in Fed rate cuts being baked in for this year to now about 80. We've seen that stocks have managed to hold up through that and have indeed thrived. Much of that has been because the increase in stocks has come at a time when, as of December, and we've of course seen this more than enough times here, the Fed said that they were going to do 80 basis points in cuts in 2024. So that's their baseline going into the year. As we now hear the Fed talk about, we expect cuts, we think 2 to 3. Fed Chair Powell's just spent 2 days saying we're not quite ready to cut, but we think the peak in rates is in. We think we're going to cut this year. That's not novel. That goes all the way back to what the Fed told us in December. 5.4 was the expectation for the 2023 Fed funds rate. And of course, by then that was essentially a given. And 4.6 is where the Fed wanted to end up. That's an 80 basis point swing. So that's 75 basis points in cuts at the standard sizing. A 25 basis point rate move is the usual. And about a 5 basis point rounding error as it looks. And so this is baseline. And when we start the year, the markets are very clearly on the dovish end of that baseline. They're at 150. And so the market is essentially saying, oh, look, money is going to be cheaper than the Fed has allowed. Let's deploy capital. Risk on. And so as you move through January, February, and better than expected U.S. economic data gives you an adjustment in rate cut odds that reduces them, and you go down from 150 to about 80, the market still has essentially a buffer in easy money to work through and says, okay, from 150 to 125, okay, still easy, still loose. 150 to 100, okay, still loose. 150 to about 80, okay, we've squeezed out all of the excess. And so you'll notice it's quite readily apparent here on the chart, I think. Once you get to just shy of 80, this stalls. And now as we sort of start to round back out to land at about 80, you get a bit of an extension. the great achievement for Jay Powell here, seemingly, that he didn't really move the needle. We are basically in the same spot this week as we were last week, and we're pinned to 80 basis points, which, if you consider the Fed forecast as this kind of benchmark, anything that's on the lower end of that seems to be stimulative for risk sentiment. Anything that might be on the higher end of that might start to get you into a spot where bad is good and good is bad on economic data. As a matter of fact, that's exactly what we've been seeing. And we'll get into that in just a moment. But where we are is essentially right at the baseline. And we can see that besides stocks, there's been a very clear response from other markets as well. The dollar has behaved as you might expect. More rate cut expectations have meant a weaker dollar since the beginning of the year. The hemming in of those rate cut expectations have seen the dollar rise. As they found a peak, so too did the dollar, and it has come off. You can see it's been weaker this week as you get the Fed basically painting us back at 80 and even just a tad softer. But at the very least, the risk that you go meaningfully north of 80 somewhere into the 50, 60 area, and we start to talk about maybe it's only 2 cuts rather than 3, that didn't happen here. And so the dollar is easing back. It has likewise started to put in the bottom on the Japanese yen, incidentally, as we've discussed here for quite a long time. This idea that because the Fed is cutting and the Bank of Japan is not, as you get evened out on both forecasts and the markets basically establish, okay, this is where we are, the yen is likely to go higher because you're likely to get a narrowing yield differential. The dollar's yield advantage is likely to be reduced relative to the yen, and that should see the yen come up off the lows. That's exactly what we've been seeing here, starting to form right at the bottoms here, and indeed over the past day, the yen has actually made a new high relative to the one before, and seems to be attempting to break out higher. Now, from here, this is the lens that we have to apply, it seems, on what is a very critical piece of this overall puzzle, the U.S. jobs report. And here's what's expected. We're looking for job creation to come in a bit, to slow to about 200,000 jobs added in February. The jobless rate has been idling at 3.7% and is expected to continue to idle there. That's only a hair above the 70-year low. That's 70-year low. Last time we saw unemployment anywhere near these levels or lower was in the early 1950s, just after World War II, that big upswing in U.S. economic activity following the war. So this is historically low for unemployment, and we're looking for that to come in exactly unchanged again. That's a step lower from the 3.8 level. That's sort of a top of the recent range, modest though it is, in October. Not a controversial report, it would seem, if we look at expectations. The 200K increase is well within the recent range of outcomes here. This basing that we've seen here would land at sort of near the middle. And, of course, not a controversial number on the unemployment rate as well. So really the question is, what is the capacity for this to surprise either higher or lower? Because if we're sitting on this baseline at 80 basis points, if we start moving toward 100, seems like the markets would consider that risk on. If we start moving in the direction of 60, 50, seems like the market would consider that risk off. So what we'd want here is to see which is the surprise risk that's more likely, and where do we then end up on stocks, on bonds, on yields, etc. And of course, we know this to be a critical indicator because the Fed has told us as much. In fact, this has been the entire Fed gambit, really, on disinflation since this whole process began. The key thing that the Fed ultimately missed about inflation, and the reason, by its own admission, it started belatedly on normalizing rates and tightening, is because it missed this bit in the housing or in the labor markets rather. Housing is, of course, an animal unto itself and the key reason for inflation, but for other reasons and mostly for the Fed's own reasons, higher rates pushing both buyers and sellers out of markets. But this is really where the sticky inflation that the Fed wants to get at lives. So here's COVID, and obviously when you get lockdowns, there's a massive oversupply of labor because everybody's essentially sent home and the economy is on lockdown. As you start to reopen from COVID, this oversupply starts to very quickly come down. And by the time we get really to the middle of 2021, we go into deficit. And that's because lots and lots of baby boomers accelerated retiring plans during COVID while everything was on lockdown. We can see a little bit of that deficit was already starting to occur as they really began to retire before, and they are the most populous contingent in the labor market still. Now, once COVID occurred, that sped up significantly. Of course, the pandemic also wreaked all kinds of other havoc, and among other things, a really dramatic rehiring frenzy once we restarted the economy. And so we can see that at the start, there was as much as a 6 million worker shortage, a mismatch of as much as 6 million between labor supply and demand. And not surprisingly, you can see here, as you get this surplus becoming a deficit, you also see inflation go from 0 to normal to very elevated. And as you begin to wind down this deficit, we've now cut it essentially in half, you also see that inflation has come down significantly. So this is really the Fed's game. They're trying to get this to keep going. And so if you were to get numbers out of NFP that were relatively soft, you would end up with the Fed saying, right, this is going our way. So far, by the way, much of this normalization from 6 to about 3 has occurred because job openings have fallen. Not really because there's been a tremendous amount of layoffs, hence the unemployment rate as low as it is. So inflation hasn't so much come down because the supply-demand balance has changed because of firings. It's because it's changed because of openings, vacancies. So there's less demand. And so the mismatch has narrowed, as has inflation. But the next leg in this is for the Fed to feel itself convinced that we are on the way lower. And if we consider the employment cost index here, this is quarterly data, so it's a little bit behind what we see in the PCE numbers here. While overall inflation has come down, let's look at the headline for the PCE here from 7.1 to 2.4. The core has come down less dramatically, but nevertheless significantly, 5.6 to 2.9. The employment cost index, because of this stickiness and this lingering deficit, has only come down from 5.1 to 4.2, less than 1%. So This is that last mile that the Fed wants to see itself squeezing before it commits to cutting rates. So if we get data here that encourages this, that is on the weaker side or broadly in line with expectations, that would ostensibly reinforce the Fed's confidence, or at least the market's thinking about the Fed's confidence, because it is a step down that's expected, as we just saw right here. And so if we got something in line that is softer, but not unexpectedly so, or even softer than that, perhaps the markets would conclude, okay, the Fed is maybe on course to do 90 basis points. So we'd inch closer toward 4 cuts rather than 3, because the progress on this will be more attractive looking and they'll have more confidence. And there is some evidence that this is the direction this might go. We saw, of course, earlier in the week, ISM data, both Friday and Monday this week, undershooting expectations. That seemed to be the start of something of a turn in U.S. economic data, which, as we mentioned earlier, had been outperforming relative to forecasts. Perhaps the most eye-catching part of this was the employment component for both manufacturing and services. That put both in contraction territory. So what this showed us, and again, this is in the logic of PMIs, so 50 is neutral, above 50 is growth, below 50 is contraction. You can see, by the way, the Fed's efforts on display here, so you can see that the direction in hiring is trending down. So you have a peak, shock of shocks, in the middle of 2021 in the pace of jobs growth in both manufacturing and services. Well, what do we recall? Here's the middle of 2021 right here. That's exactly where you'd see the turning point occur. Then you can see it starts to decline here. Inflation starts to decline. You can see that right here. It begins to come off here as the Fed raises rates. And for February, both readings are below 50. That is, they are in shrinking mode. And both accelerated in that direction. So in the case of services, we went from neutral to contracting. And in the case of manufacturing, the pace of contraction accelerated. So that speaks to just shrinking speed of hiring. And of course, warns that the report might be soggy. ADP data, not the greatest of forward-looking indicators, to be sure, but of a theme. Also a bit weaker than expected. 140,000 added to private payrolls according to ADP versus 150,000 expected. And all of this seems to be forming something of a trend. So we're looking here and now saying, all right, this is what we've seen since the beginning of the year. U.S. economic data is outperforming expectations. Rate cut expectations are then coming down, as you might expect in this kind of an environment. Incidentally, the break above this surprise index's 20-day moving average was the trigger for this, much as it was the trigger for it in the middle of the year, which as it was last year, much as it was the trigger for it at the start of last year. So when you go through the 20-day moving average here, which is about a month's worth of data points, 5 a week, 4 weeks, there seems to be a kind of cyclicality here. to rolling over on the direction of data outcomes relative to expectations. And after this soggy run late last week into this week, we seem to have turned a corner here again. Now, the index is still in positive territory, suggesting we're still nominally more likely to surprise higher versus lower, but clearly the margin is narrowing, and that's at least as likely to be because expectations have been increased after this run right here. And so essentially the bar is higher, and now it's more difficult for data to beat expectations, as it is that the data is actually weakening in absolute terms. But nevertheless, this raises a red flag and says, we've turned here, perhaps models have been adjusted, NFP might well undershoot in this environment. Well, if it does, the message that we get from what we see here is that means probably higher stocks because this moves lower, probably a weaker dollar because this moves lower, probably a higher yen because this moves lower. Because a weaker report would suggest the Fed can get closer to cutting rates. The wild card here is that if, in fact, this sign of contraction in employment activity across both sectors is more ominous than it seems. And if, in fact, the report isn't just weak relative to forecasts in the benign, oh, good rate cuts kind of way, but if it's weak in the, oh, no, this recovery has hit the skids kind of way. If all of a sudden we get a report that is not necessarily just a little weaker or in line, but a lot weaker, if the rollover in U.S. economic data speaks to a more ominous turn in economic activity at the larger sense, suggesting that the outperformance in the U.S. economy that we have been seeing last year and this year is hitting a wall of some kind, well, then it seems difficult to imagine that stocks would celebrate. And so what you might instead see is a period of risk aversion. In that environment, you get stocks lower despite the weak data, and in fact, because of it, because the concern becomes about the business cycle. That's if you get some sort of out of trend number. You then probably get a stronger US dollar, despite the fact that this probably means higher bonds and lower yields, because liquidation starts to boost the most liquid form of cash. If liquidation goes anywhere, it's typically the dollar. But then, of course, there's also the yen, which is also typically a beneficiary of risk-off liquidation. And that's where things get really interesting. Because it seems if you get a number that's a little weak, well, stocks go higher, dollar probably falls, yen probably goes up. If you get a number that's liquidation scary weak, stocks probably go down, dollar might go up, but the yen still goes up. Maybe even more sharply so. And so the worst case scenario as a buyer of yen here perhaps is that the numbers actually surprise higher. And that because you've now had a soggy run of input jobs data, be it ADP, as we just looked at, or the employment components of ISM, that you've priced this in already, that the market is primed to miss a bit. And then if you don't, or if you come in a little bit warmer, now never mind a lot warmer, you upset the apple cart. Yen falls, dollar rallies, stocks are hurt. But for 2 out of 3 of these scenarios, the yen seems positioned to extend higher. And that is macro money for today. No futures power hour Tomorrow, Chris and I are going to patiently wait for the new Tasty Live studio to be created. Both Macro Money and Overtime, the show that precedes it, that I co-host with Chris and Dylan Radigan, will come back on Monday per the usual. The summary of this analysis here is sitting on tastylive.com in the News and Insights section per the usual as well. And I will continue to opine sporadically about these markets on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you next week.